Welcome to the deep dive. Today, we're going to zero in on Zaggle prepaid ocean services. Most people just call them Zaggle.
Right. They kicked off back in 2011, operating in India's spend management sector. It's quite a dynamic area.
It really is.
Yeah.
And what makes Zaggle interesting is, how they sit at this crossroads.
Yeah, the intersection of SaaS, software as a service, and fintech.
Exactly. So instead of businesses juggling, lots of different systems for money stuff.
Zaggle offers this one integrated platform, cloud-based.
Yeah, it brings together things like employee benefits, managing expenses, accounts payable, even some personal finance tools thrown in.
And it's designed for both sides, right? There's like a dashboard for the company admins and then a mobile app for the actual end users, the employees. Makes it easier for everyone.
Connects to their bigger goal, doesn't it? They talk about building state-of-the-art fintech solutions.
Right. To automate and empower businesses. It's all about making things more efficient, more accurate, transparent.
Helps boost productivity, too. And it fits into that whole push for India becoming a more digital economy.
And they've certainly made waves. They're actually India's leading prepaid card issuer now.
Those numbers are pretty big. By the end of March 2024, we're talking over 50 million cards distributed.
Wow.
And serving more than, 2.73 million users?
That's some serious reach. Gives them a solid foundation.
Yeah.
So, okay, where do we start with financials?
Let's jump right into the latest numbers. The financial year that ended March 31st, 2025, so FY2025.
Oh.
This info comes from their investor presentation dated May 12th, 2025. And the founder, Raj P. Narayanam, he actually said that their FY25 revenues beat their own guidance. They crossed INR 13,000 million.
13,000 million, okay. And the growth?
A huge 68.0% jump compared to the previous year. And the profit after tax, the PAT.
That's the key one often.
Right. It came in INR 874.8 million, which is almost double what it was last year.
Doubling profit. That's significant. It shows the growth isn't just top line. They're getting more profitable.
Yeah. Definitely. And they made a point of saying this is their highest ever performance for the third time running.
So consistent record breaking.
Seems so. If you look just at the last quarter, Q4 of FY25, the revenue was INR 4,114.5 million. Still strong growth, 50.5% year on year.
And the profit for that quarter?
PAT for Q4 was INR 319.6 million. That's up 66.8% year on year. Also pretty substantial.
Okay, so the momentum carried right through the end of the year. It wasn't just a fluke earlier on. This suggests, a really strong underlying trend.
Exactly. They put it down to, quote, strategic execution in FY25. Things like making key investments, rolling out product innovations, all aligned with their long-term goals.
Makes sense.
They also specifically mention focusing on deploying emerging AI technologies.
AI. That's always interesting. Wonder how they're applying it. Better expense tracking, maybe? Fraud detection.
Could be. Or maybe more personalized benefits. They didn't detail it in this part, but it's clearly on the radar.
Something to watch.
Looking forward now to FY26, the current year. They're guiding for organic top-line growth between 35% and 40%.
Still very healthy growth projected.
And they've actually increased their guidance for the EBITDA margin, now expecting it in the range of 10% to 11%.
Okay, so focusing on profitability alongside that growth, how are they planning to boost margins?
Seems like the usual suspects, but important ones. Operating leverage, basically. As revenue grows, fixed costs don't grow as fast.
Right, economies of scale.
Driving up profit. Also just general efficiencies and cross-selling more services to their existing clients.
That combo solid growth plus margin focus is often what investors like to see. Shows a path to sustainable profitability.
Let's drill down a bit more into those Q4 FY25 numbers. Revenue from operations, like we said, 4,114.5 million, up 50.5% year on year.
Okay.
Adjusted EBITDA, so that's earnings before interest, tax, depreciation, amortization, and adjusted here for ESOP costs.
Right, employee stock options.
That was 379.3 million, up 39.6% year on year.
Solid growth there, too.
The PAT we mentioned, 319.6 million, up 66.8%. And then there's cash pay,
Which adds back non-cash stuff like depreciation.
Exactly, and ESOP expenses. Gives the sense of actual cash generated. That hit 394.1 million in Q4, an 85.5% increase year on year.
Wow, that cash pay T jump is really impressive. Nearly doubled. Shows strong cash flow generation in that quarter.
And these strong Q4 numbers basically cap off a really strong full year, FY25.
Let's hear the full year totals.
All right. Revenue from operations for FY25, $13,026.5 million. That's the 68.0% year-on-year growth.
Okay, got it.
Adjusted EBITDA for the year, $1,244.9 million, up 45.5%. PT, the one that nearly doubled, $874.8 million, up 98.7%.
Almost bang on double. Incredible.
And the full year cash PT, $114.3 million, which is up 65.4%.
Right.
And again, they highlight this is their highest ever performance across all these key metrics for a full financial year.
The consistency is key. Strong quarter, strong year. Paints a very clear picture of upward momentum and improving financial health.
Let's look at a direct comparison, Q4 FY25 versus Q4 FY24. Revenue up 50.5% to euro 4,114 million.
Yep.
Gross profit, so revenue minus direct costs, that increased by 17.6% to 1,898 million.
Okay, so gross profit grew, but a bit slower than revenue in that quarter. Maybe some cost pressures or investments in service.
Could be, but then reported EBITDA jumped 34.6% to euro 367 million, and adjusted EBITDA was up 39.6% to 379 million.
Right, so they managed profitability well, despite maybe some gross margin pressure.
And that cash pat up 85.5% to 394 million in the quarter.
Yeah, that's the standout quarterly figure.
Now, the annual comparison, FY25 versus FY24, revenue up 68.0% to 13,228 million. Again, slightly slower than revenue growth over the full year, but still very strong growth.
Reported EBITDA up 63.2% to 1,152 million. Adjusted EBITDA up 45.5% to 1,245 million.
Okay.
And cash pat for the year up 65.4% to 11,114 million. These year-on-year numbers just really hammer home the scale of the expansion and the improvement in their financial standing. It's across the board.
They also shared some operational metrics. Total customers catered to reach 3,455 in FY25. That's up 14.6%.
Decent growth in customer base.
And the total number of users on their platform grew to 3.28 million in FY25. That's a 20.1% increase. So getting more users per customer, perhaps, or bigger customers.
Yeah, possibly both. Shows platform adoption is growing faster than just the client count.
Briefly on the revenue mix, they break it down into software fees, program fees, and Propel platform revenue. The big story seems to be a really significant jump in program fees in FY25 compared to the previous year.
Program fees often relate to transaction volumes on the cards, right? So that aligns with the user growth and overall activity.
Makes sense. They also summarized some key P&L highlights for Q4, obviously the highest ever quarterly and yearly numbers we discussed. They attributed the top-line growth mainly to their Zoyer solution, plus organic growth, either Save and Propel products, also new client wins, user growth, and those cross-sell efforts.
Okay, so a mix of factors driving it.
They did note increased employee costs, which kind of makes sense given the business expansion.
You need more people to manage growth.
Right. But interestingly, they had reduced incentives and cash back year on year in Q4 25.
Maybe pulling back on some promotional spend as they scale could help margins.
Possibly. They also mentioned increased depreciation because they capitalized some assets related to Zadex and Fleet Solutions, perhaps acquisitions or internal developments becoming operational.
Right, standard accounting as assets come online.
And they expect total ESOP expenses in FY26 to be around INR 90 to 100 million. Just something to note for future profitability calculations.
Good context on costs. Anything on the balance sheet?
Just briefly, a rise in intangible assets, again linked to capitalizing Zadex and Fleet Solutions. Also, intangible asset under development suggests ongoing investment in new products.
So, investing for future growth.
Yeah, and their investments line item represents strategic acquisitions like TaxBanner and Mobileware.
Okay, so growth through acquisition is also part of the strategy.
So wrapping things up a bit, the main takeaway has to be Zaggle's really impressive financial run in FY25.
Absolutely. They didn't just hit targets, they blew past their revenue guidance and almost doubled their profit. That's a strong statement.
Yeah, the year-on-year growth across pretty much every key metric we looked at was substantial. And the outlook from the founder seems quite positive, too.
It really points towards a business model that's working well and effective execution of their strategy in that SaaS and fintech space for spend management.
Definitely looks like that integrated approach is resonating.
So it leaves us with a thought for you, the listener. Considering Zaggle's strong growth, their focus on things like AI and these strategic acquisitions, what do you think are the biggest potential growth areas or maybe even challenges for them going forward? Where could they make the biggest impact in this whole spend management landscape in India? Something to think about